Tech stocks mostly following the same playbook. They had a monster run and then some corrections the last few weeks, most recently in Facebook, as you obviously know. Education tech company Chegg is up 8% this morning after almost doubling in the last year. This was a $3 name in 2016, $27.45 today. Dan Rosensweig is the CEO and joins us this morning on the back of earnings. Dan, good to talk to you again. Good morning.
Good morning, Carl. How are you?
Pretty well, not as well as you, I guess. 32% revenue growth, subs up 45. You raise your guidance. I wonder, talk about the quarter, but also the fact that you got caught a bit in this downdraft the last couple of days.
Yeah, look, the quarter was great. We're in a very big segment. Education is $1 trillion segment. We converted our business model from analog to digital about 2 years ago, and now we have extraordinarily high growth rates, high margins, and a very big TAM. And so we feel very comfortable that we're building a business with an incredible mission to help students improve their education, get their materials for less, learn, master the subjects, and get a job. And there's nothing else that really matters more in their lives than that. So we're ecstatic about that opportunity. In terms of the downdraft, it's just part of being a public company. It's hard to figure out how these funds work these days. They rotate in, they rotate out. Clearly, the advertising companies, Facebook and Twitter, sort of had a different view on the quarter than the subscription companies like ours or Netflix or even Amazon now with the cloud and with Prime. So I think investors will figure out that these companies are not the same after a while, and that should be good for Chegg.
Dan, looking at your numbers, and Carl just pointed it out, services subscribers increased 45% year over year. Clearly, there is demand for more tech and more disruption in education. It has been a long time coming. Where do you see the greatest opportunities?
Yeah, it's a great question. And our view is just bet on the inevitable. It's inevitable that more people are going to learn online, not less. It's inevitable that you should be able to use technology to make it on demand, make it adaptive, make it personalized, make it less expensive, make it more relevant, and be able to teach people at the level that they enter the system as opposed to the level you hope they entered the system in. And so what you're seeing with Chegg is we now have 1 out of every 2 college kids approximately is registered with our site, and 1 out of 4 by the end of this year will be paying us for something. So clearly you're right, the demand is there, but we're doing something very straightforward and very simple. We're helping them save time, save money, and get smarter. And so think about it. You're a young person, 70% of them go to state school, 40% of them work 30 hours a week or more, 25% of college kids actually have a kid while they're in college. So what we are is we're available to them at the time they're available to learn, whereas classrooms are not. They program a schedule, and you can either make it or you cannot. And so we look at it and we say, as long as we can help students master their subject, pass their class, learn their career path, lower their costs, and then get a job that they want, that we're going to be one of the most valuable companies on the planet. And that's the mission that drives our employees. And as you can see, the business has really captured fire right now.
Dan, you mentioned the large addressable market that you're in and how, of course, that's kind of music to tech investors' ears, right? When you have a small piece of a very large market. Obviously, other companies are going to be aware of that, too. How do things feel to you in terms of the M&A environment? It seems like a lot of small, mid-cap, internet-based companies have really had a lot of run. And part of the story is, well, at some point, there's going to be some kind of consolidation. What do you view that?
Yeah, look, I think that tech has always been an industry that consolidates and evolves or dies. So you've got the breakaway companies, the ones that have hit escape velocity, and they start as companies that define their category. So remember, Netflix defined its category, Google defined its category, Facebook defined its category, PayPal has defined its category, and Chegg is defining its category. So we see ourselves as a consolidator as opposed to necessarily be one that gets consolidated. But the truth is, there's more and more people who want to go direct to their customer. Look, if you own your customer and you own the data and you own the channel of distribution, and like us, you own proprietary content, you have the ability to satisfy your customer at a lower price and higher value than anybody else. And so we do see a lot of what you just mentioned, which is consolidation. We've become a consolidator. In fact, we acquired 2 small companies in our space, because what's happening is these companies either build an audience or they don't. And if they build an audience, they don't necessarily have a business model that they can monetize. But as part of something bigger, like when Facebook bought Instagram, or when Chegg acquired EasyBib, we have the ability to use our reach, our brand, our data to grow them faster and have them be much more profitable. And so that's the same game plan we're following. But I do think you're right, which is if you look at the tech space, most companies don't end up going public or staying public. And that's just a fact of our industry. But we see ourselves hopefully as one of the consolidators as opposed to the other way around.
Finally, Dan, one question, Chegg, the speed bump that we've hit in FANG the last few sessions, do you see it as that, a speed bump, or are real negative biases being formed, whether it's on hardware because of trade and supply chains, whether it's on social because of what Facebook said about engagement and cost?
Look, I think in the short term, there are very real considerations, which is there is an issue over trade war. There are issues over tariffs, right? On the Facebook side, there's issues over the fact that, look, Mark stood before the government and said, I'm going to fix this. We are going to invest whatever it takes. And then it surprised everybody that he chose to invest in whatever it took. But I think what you're going to find is these are speed bumps at best, which is there's no way people are going to stop advertising on Facebook right now. And there's no way that people aren't going to want the hardware that they want. And so initially there'll be bumps in the road, there'll be unevenness, there'll be volatility. But if you wanted to bet on which companies were going to get bigger over the next 3 or 4 years, it's still going to be Facebook, it's still going to be Amazon, it's still going to be Netflix, it's still going to be Google, and we believe, hopefully, it's still going to be Chegg. But I think they're speed bumps, they're not walls.